Hello class, this is Dr. Fenton. In this video, we are going to cover Chapter 11, which deals with performance measurement in decentralized organizations. Now make sure that you read the chapter in detail and use this video to help understand the high points of the chapter and the examples given to you within the chapter. So let's get started. Now decentralization is when decision-making authority is spread throughout the organization rather than being confined to a few top executives. You might say, well, why do you want to do this? Well, here you can look at some advantages. And the first one, by delegating day-to-day problem solving to lower-level managers, top-level managers can concentrate on bigger issues such as overall strategy. And the second one, empowering lower-level managers to make decisions puts the decision-making authority in the hands of those who tend to have the most detailed and up-to-date information about day-to-day operations. So if you allow managers out in the field, like scattered around the country in different divisions, if you allow them to make the decisions, they have the local information they need to make their divisions more successful. So it might make for a more efficient operation of the entire organization. You can read the others yourself, 3, 4, and 5, and also you can read about the disadvantages in decentralization. Here we have some definitions we need to go over. First is the cost center. We can click here for a short definition. A cost center is a business segment whose manager has control over cost but has no control over revenue or investments in operating the assets. So what type of area would this be? This could be service departments such as accounting, finance, and general administrative, even legal and personnel. It can also be manufacturing facilities. So these areas of the company, they spend dollars, they incur cost, but they don't generate revenues themselves. A profit center, on the other hand, is a business segment whose manager has control over cost and revenue, but no control over investments and operating assets. So in these divisions, they do generate profits. These can be departments within a store, they might be selling clothing in one area and then home goods in the other area. So they try to generate profits by increasing revenues, but they also have costs that they incur. The third one is the investment center. This has all three. So a business segment whose manager has control over cost, revenue, and investments in operating assets. And these managers have decision-making authority over do they build new buildings? Do they buy more expensive equipment for their areas? So they have control over everything. They're trying to generate revenue. They are incurring cost to do that. And they can purchase investments as they see fit. If we are going to have a decentralized organization and let managers make decisions, then we'll need to find a way to evaluate the performance of those managers. One way to do this in the investment center is to compute something called return on investment. We have several formulas on this page, and hopefully you remember these from your first accounting course. Now, return on investment, as you can see, is net operating income divided by average operating assets. What kind of return are you generating based on the assets you have invested in that business or that area of the business? Let's define, though, those two terms. Net operating income. This is not net income. If you remember in the multi-step income statement, about halfway down or so, we came up with a term called net operating income. Now below that on the income statement, you had taxes taken away and other items, non-operating items. So this is often referred to as, you can see it here, EBIT, earnings before interest and taxes. So that will be our net operating income. Now we have average operating assets, not average total assets. So what are operating assets? You can see the definition here: cash, accounts receivable, inventory, plant and equipment, and all other assets held for operating purposes. Well, then what would not be an operating asset? You can see some examples here: land held for future use, an investment in another company, or a building rented to someone else. So you're trying to divide the operating income you have from the business by the average operating assets, in other words, the assets you're using to generate that operating net income. To understand ROI a little bit further, we can break it down into two parts, margin and turnover. I'm not sure if you can read that full word right here, but that's margin and turnover. So what is margin? Again, you probably had this in your first accounting course. Margin is simply net operating income divided by sales. Turnover will be your sales divided by average operating assets. So it's a nice simple definition. Let's see how to use that. So here's an example. We have sales $100,000, operating expenses $90,000, net operating income $10,000, and average operating assets of $50,000. So here's the expanded return on investment formula. So let's first of all compute margin. So net operating income, $10,000, divided by sales, $100,000. So here it is. Turnover, sales divided by operating assets. Here's this amount. So we have 10% margin. We have a 2 turnover amount. So if you take 10% times 2, 20%. And so return on investment is 20%. Now you can see quickly that the shortcut, of course, is to divide net operating income by average operating assets. So if you look at the algebra related to this, the sales would cancel each other out, and you're left with net operating income over your operating assets. But anyway, you can do it two different ways. The simple way, as we saw right here, is just a quick computation, or expand it out with the margin and the turnover. Either way will get you the same answer. You can look at this chart that just shows you, where does return on investment come from? Well, all these other accounts and computations. So you can look at that, and you can read the criticism ROI yourself. Let's go to the next page. Another way to evaluate the performance of an investment center is called residual income. Now, residual income is the net operating income that an investment center earns above the minimum required rate of return on its operating assets. So let's see what this is. Expanded out a little bit, it is equal to take your net operating income, subtract the minimum you require of operating income based on the assets that you have invested. So you take the minimum required rate of return times your operating assets, whatever this result is, subtract it from your current net operating income to get the residual. It's the excess net operating income above the minimum you would like to have based on the amount of assets you have invested in that part of the business. There's another concept called economic value added concept. We're not going to make the distinction between this one and residual income. They do describe what it is here. Some companies use this. And what they do, they change the accounting around a little bit just for this computation. So for example, funds used for research and development are often treated as investments rather than expenses. So don't worry about this. Just know it is another alternative, and it's very similar to the residual income approach. Let's look at an example. Here we have the Alaskan Marine Services Corporation, and they have the Ketchikan division. And here's what the Ketchikan division is doing today. Currently, we have operating assets of $100,000. Net operating income is $20,000, and the minimum rate of return required by the company is 15%. What is the residual income for this division? It's computed in this far right column. We have the operating assets, and let's take these times the company's required minimum rate of return, 15%. And so we get $15,000. The company, you can see, has $20,000. Drop it in. So what we're doing is taking the $20,000 of the current net operating income and subtracting the minimum required rate of return, or return I should say, based on the assets we have invested, $15,000. So in other words, we're earning 15, the company would require, no, we're earning 20, and the company would require 15. So we have residual income, the excess of $5,000. Now here's the ROI, 20%. just taking $20,000 divided by $100,000, 20%. So this is your ROI right here, but our residual income is $5,000. Now let's apply this more and see how to use it. So the Ketchikan division has a choice. Should we accept this new project or not? Here are the current numbers. We just saw this before. Residual income $5,000. Current operating income is $20,000. And we have $100,000 of investment. The new project would require $25,000 more in investment, would generate $4,500 in additional net operating income. If we take $25,000 the new investment times the 15% required rate of return, we have $3,750 as the return we would like to have, the extra operating income we'd like to have based on this investment amount, $3,750. We are above that. We predict it will come out with $4,500. So we would increase our overall residual income by $750 if we accept this new project. So this looks good, right? What if we evaluated this manager just based on the ROI percentage? Let's look down here. Currently, we are generating 20%. Okay. The new project, when you look at its additional net operating income compared to, divided by the project investment, it's only 18%. If you do accept the project, your overall numbers go up as to operating assets and operating income, but your ROI drops a little bit. So think about this. If you're the manager of this division and you have the choice to accept this new project and you are evaluated just on the ROI percentage you generate, would you accept this project? You're currently generating 20%. The new project generates only 19%. 18%. It drops you down to 19.6%. So if your, let's say, year-end bonus is based on a possible 20%, why would you make this decision to drop it down to 19.6%? It might hurt your bonus. So you might not make this decision to accept the new project, just for your own benefit, but the company would benefit. In the residual income, that would go up. So maybe, just maybe, the residual income approach is a better way to evaluate managers of these investment centers. So here's an example to show that. You can read the rest of this yourself. Let's go to the next page. Now this page is showing another way to evaluate performance. And the first one here is the throughput or manufacturing cycle time. Now we're not going to be tested over this, so don't worry about it in detail. This just shows you that if you're in the manufacturing area, you're always worried about getting the product out the door. How much time does that take? Well, it's the process time. That's what you spend working on the product. You have to inspect the product for quality control. You have to move the product, maybe while it's being worked on and after it's being worked on around your business, the floor shop area, and into the finished goods warehouse area. And the queue time is just waiting time. What you want to do to become more efficient is eliminate as much time as possible in these three non-value added activities. The only value added activity in this process is your process time. And this whole cycle time is your process time. These don't add value. Yes, you have to have them. You have to inspect them, move them, and sometimes have to wait to be moved or to be sold. So you want to eliminate these three as much as possible. That's why it says here. Eliminate the time that you can to make it more efficient. There's at the manufacturing area. Delivery cycle time the same way. There's wait time and there's throughput time. That's the whole delivery cycle time. So here you try to eliminate the non-value added time as much as possible. So I'll let you read the rest of this yourself. Again, don't worry about this formula or anything else on this page. One way to evaluate the company as a whole is to adopt the balanced scorecard approach. So what is this balanced scorecard? It is an integrated set of performance measures that are derived from and support the organization's strategy. Well, let's take Southwest Airlines as an example. They want to offer operational excellence, to their customers. How do they do this? Low ticket prices, convenience, and reliability. One way they try to operate efficiently and therefore lower cost is to have only one type of aircraft, the Boeing 737. So if you're an airline company and you have only one type of aircraft as opposed to a dozen, your maintenance costs are going to be a lot less, your training costs will be a lot less, scheduling be a lot easier because when you move planes around the country, you're moving the same type of aircraft all around the country. So they try to operate efficiently. That's why they are known for low cost. Now, to try to set up your goals and performance measures, then you first start with your vision and strategy for the company. And out of that, you might have some financial goals. What are they? Performance measures, one question, has our financial performance improved? Again, out of vision and strategy, what about your customers? What customers do we want to serve, and how are we going to win and retain them? So we're here. Do customers recognize that we are delivering more value? And then out of, again, vision and strategy, internal business processes. So you might ask the question, have we improved key business processes so that we can deliver more value to customers? In the learning and growth, are we maintaining our ability to change and improve? Let's glance at this chart. Again, these can be a number of items that you would measure for a company. So the first one, customer perspective. Customer satisfaction as measured by surveys. Yes, you want that to increase. Number of customer complaints, you would like for that to decrease. You would like to increase market share, and so forth. Of course, new customers, you want them to go up. Internal business processes perspective. You would like to have percentage of sales from new products increase. Time to introduce new products to market, let's decrease that time. You want to get on the phone with your customer within 20 seconds. Answer their phone call. You want to increase that performance. Down here, remember the delivery cycle time and throughput time. You would like that time to decrease. Your manufacturing cycle efficiency increase. And get down here to the learning and growth perspective. Suggestions per your employees. You would like that to increase, and you would like to decrease employee turnover. So these are just some of the measures a company can have in their company. Read these paragraphs yourself. Has good information in them. And then we're at the end of the chapter. So again, we are looking at how to evaluate performance. We start out with cost centers, profit centers, and then investment centers. We looked at investment centers a lot closer, and we evaluated them based on return on investment and residual income. Then we talked about some efficiency as to time, manufacturing cycle time, and so forth, and then discussed the balanced scorecard. So again, go back and read the chapter in detail, and good luck with your studies.